Now we are looking at another important topic, which is called bond valuation and analysis. Bond valuation and analysis. What is a bond? A bond is a debt instrument required the issuer to repay to the lender a certain amount which is borrowed plus interest over a specified period of time. Now, of course, we know that there are various means by which an organization can decide to go into operation. So there are so many ways of raising funds. There are so many ways by which you can raise finance, and one of it is what we refer to as a bond instrument. Of course, we know that generally under capital budgeting, we know that we can raise funds using two major methods, which is either you raise equity or you raise a debt. And we know that, of course, when you talk about capital mix, you know that for every organization to survive, it is preferable when you have a mix of equity and debt. So now, without much ado, when you talk about raising debt, you talk about that there are various means by which you can raise debt, and one of it is by using what we call a bond, by raising a bond. So, what is a bond? And we have said that a bond is a debt instrument that is required by the issuer to repay the lender. Who are the issuer? Issuer are also referred to as the borrower, like the person that wants to really use the money. It is required that they pay the lender, the person that the money is coming out from them, the amount that is borrowed plus interest over a specified period of time. That is what we will refer to as bond. That's what we refer to as bond. So after we have defined what we refer to as bond, it is important that we look at some definition of terms under this bond valuation. There are some things that is important for us to know and understand for us in order for us to appreciate this topic better. And let's look at basically some definitions. And number one, we look at what we call a par value. What is par value? Par value, it is the stated amount. Par value is the stated amount of the bond. It is also referred to as face value. It's referred to as face value. So it is what we can refer to as principal in other terms. Like, it is the core value of the bond without taking interest into consideration. Like, how much do we want to borrow? Then it is at the point of repayment that we now need to now consider, okay, what is the interest element on the amount that's borrowed. So the par value is the real value, the worth of that bond that we are talking about. Now, another thing we need to understand is coupon rate. What is coupon rate? What is coupon rate? Coupon rate, it is the stated annual rate of interest on the bond. E.g., a 9% coupon bond means that annual interest on the bond is 9% of the face value of the bond. When you hear what something like a coupon rate is also known as interest. Coupon rate, you will agree when you are doing what we call simple interest, you understand that there is something that we refer to as interest. That is the additional amount of money that is payable for making use of a particular capital. So, and the same interest is what we refer to as what? Coupon rate. I said coupon rate is also known as interest rate. Is also known as interest rate. So coupon rate is also known as interest rate. So let's move on. Another thing we need to understand is that there's something we call zero coupon. There's something we call zero coupon bond. What is zero coupon bond? We say that these are bonds that do not pay any interest during their life. They don't pay any, that's why we call it zero coupon bond. That is, or what we can refer to as, say, no interest bond. No interest bond. So, having said that, we said that these bonds generally mature at face value. They mature at face value, but they are issued at a large discount to the face value. They are issued at a large discount to the face value. Hence, the return on such a bond is capital appreciation, which is the difference between the issue price and the face value. Of course, when we say zero coupon bond, we might be looking at it that okay, for a company to issue a zero coupon bond, then where is the revenue coming from? We can say that where is the revenue coming from? We can say that how would they make their money back? Because we are lending out the capital. So where is the interest coming from? So, and we are saying that where the money is coming from, which is the return, is what we refer to as capital appreciation. And what is capital appreciation? Capital appreciation is the difference between the amount at which we issue the bond and the face value of the bond. The face value of the bond is the real worth of the bond, while the issue price is the amount that we issued the bond is. So the difference between the two is what we refer to as capital appreciation, which will come back to the entity as an inflow, or what we can say as a revenue. Another thing that we have is what we call a putable bond. What is a putable bond? Under this type of arrangement, bondholders has the right but not the obligation to sell the bond to the issuer at a predetermined price. They have the right but not the obligation. Now, when we go on, we are still going to define, okay, I think it's here also, callable bond. Callable bond. And we'll say that, okay, let's go on. So what does this mean? What does this mean? This means that a put option increases. This means that a put option increases the value of the bond to an investor, since it provides the investor with protection against the bond trading below the put price. It means that a put option increases the value of the bond to an investor. When there is a put option, that means that the bondholder, they have the right to sell the bond to the issuer at a predetermined price. So what we are saying is that in our financial reporting, we have done something like what that we call sale and leaseback arrangement. Sale and leaseback arrangement is a situation where the owner of the asset has the right to buy again the asset after leasing it out. That is, the person has leased the asset. After leasing the asset, so I have the right to go and say, okay, this asset that I have even leased for you, now that is for you, now I want to buy it back. So now it is just to retain the value of the asset and to still have cash. That's just the strategy behind the sales and leaseback arrangement. So we are saying that similar to sales and leaseback arrangement, a pull option is that we are saying here that the bondholder, he has the right but not the obligation to sell the bond back to the issuer at a predetermined price. So it's just as if the what's it called now? The bondholder, that is the person that now has the bond, the person that is meant to pay interest on the bond, is now giving the person now has the right to issue back the bond back to the person that sell it. He has the right to sell the bond to the issuer at a predetermined price. Don't forget that in this kind of arrangement, the person that still issued the bond is still remain the principal owner of the bond. It's just that it is just an arrangement. It's just an arrangement that helps the holder of the bond to be able to generate some amount of revenue from the issuer. So it means that the pull option increases the value of the bond to an investor, since it provides the investor with protection against bond trading below the put price. That is, since the bond is still with the issuer, the investors are still safe. They can still feel secure that okay, our bond is still with the company that has it. It's just that our bond is still with the company that has it. So as a result of that, we are sure that we are not under trading. We are not under trading, and the bond is not being issued below the normal put price. So this is the otherwise of a callable bond. A callable bond is a situation where the borrower has the right to repurchase the bond at a predetermined price at a certain time. The borrower is just like the opposite. Now here the borrower, the person that is collecting the bond, he has the right to repurchase. The person has the right to repurchase the bond at a predetermined price. At a predetermined price. So let's look at what we call a premium bond. What is a premium bond? A premium bond, a bond having its market value greater than its par value, is known as a premium bond. That is, when your market value is higher than your par value, then this comes to a premium bond. When your market value is higher than your par value, then you have a premium bond. If it is the other way around, that is when your market value is lesser than your par value, it's called a discount bond, or what we can refer to as a discounted bond. So I said that because of the inverse relationship between the yield and value, the market yield of a premium bond is less than the what? The coupon rate. The market yield of the premium bond is usually lesser than the coupon rate. Now let's just look at an example that further buttresses the point that we are trying to raise. So we say here that a bond with a face value of 1,000 naira pays annual coupon rate of 8%. If the bond has yield to maturity of 10% and maturity of 5 years, this is the period. Now we are asked to compute the current market value of the bond. So this is just a suggested solution of how we can approach this kind of question. So the first thing we need to say is that the market value of the bond is given by the PV of 80 naira. The PV of 80 naira due from year 1 to 5. Plus the PV of the face value of 1,000 naira due in year 5. What am I saying? How do we arrive at the 80 naira? The 80 naira is simply the 8% of 1,000 naira. If you do your calculation well, 8% of 1,000 naira is simply, will give you 80 naira. So that's how we arrive at the PV of 80 naira due from year 1 to 5 plus the PV of the face value, which is 1,000 naira. Going back to the question, we saw that the face value is what? The face value is 1,000 naira and the interest, which is the coupon rate, is what? Is 8%. Now we can now go back to our MPV. So coupon, also known as interest, for year 1 to 5 on a cash flow of 80. So if you do your annuity using the annuity formula, you are going to have your DCF to be discounted cash flow at 10%. So your DCF will be 3.791, which gives you 3.791 multiplied by your cash flow. You have your PV of this. The face value at the end of year 5, which is 1,000 naira cash flow, DCF at 10% for year 5 will give you 0.621, which gives us this. Addition of the two PV, you have 948.28, which is the market value of the bond. So now we're saying here that the market value of 924.28 is less than the face value of 1,000 naira. Can you see? The market value of 924.28 is less than what? Than the face value of 1,000 naira, because the yield to maturity of 10% is higher than the coupon rate of 10%. So this situation is usually referred to as a discounted bond. Yeah. So remember I said that once your market value is higher than your face value, then you have what we call a premium bond. But if it is the other way around, that is when your market value is lesser than your face value, then we have what we call a discounted bond. So this is a situation of a discounted bond because our market value is lesser than our face value. So let's look at another example. example 2. So here we are saying that the following is a list of prices of zero coupon bonds of various maturity. So the one that mature in year 1, we have this. In year 2, we have this. Let's move on. Year 3, we have this, and year 4, we have this. So we are asked to determine the spot rate for each of the 4 years. That is RO1, returns on year 1, on year 2, 3, and 4. And we say that these are the yield to maturity of each of these bonds. Now, solution. The yield to maturity of each zero is the rate of interest that makes the market value to grow to become the face value of mature. We're just trying to define it here that it is the spot rate for the relevant year. So now let's do the calculation. Of course, we see that the yield to maturity, the YTM for year 1 is 943.4, and that's how we have this plus into 1 plus RO1 raised to power 1. Then we have the face value of 1,000 naira. Our interest rate is at 6%. Right? Let me confirm that. Oh, okay. So if you do this very well, sorry, if you do this by making RO1 the subject of the formula, if we decide to make RO1 subject of the formula, if we solve this equation, we're going to have something like 0.06, which gives us something like 6%, and that's what we have here. So if you solve this equation, you are going to have the 6%. Yeah. So the same thing for RO2. If you solve this equation, you have 5.5. For RO3, you have this, and for RO4, you have this. So this is just a way of calculating the returns that is derivable of the zero coupon bond. And remember, we said something that when we are talking about the zero coupon bond in the definition, that it is just what we refer to as capital appreciation. That because there is no interest on it, so it is just the difference between the face value and the issued value, the issued amount. So when the face value, when the face value is lesser than the issued price, then we have what we call the rate, and that's how we generate money. So we are just trying to look at the effective rate of the difference between the face value and the actual amount that the stuff was issued, that is the bond was issued. Critically, let's look at another example. A bond has a face value of 1,000 naira and is to mature in 4 years and offer a 6% coupon rate. The market yield is 7%. Now, using mean deviation, we are asked to estimate the revised price of the bond if the market yield increases to 7.4%. If the market yield increases to 7.4%. So let's look at the solution. Here we say that the current price of the bond is estimated as follows. The current price of that bond, so let's see. The P, which represents the price, 60. This 1.07. Of course, I believe we know that it's the same thing as saying that 1 plus 0.07, which is the market yield, MY, as market yield. This 60 is as a result of 60. I want to write 60 is as a result of 6%, which is the coupon rate on the face value of the bond. It will give you 60, and that's how we come about this 60. So this one is for year 1, this is for year 2, this is for year 3, this is for year 4. Adding everything together, you have the price of the bond, which is 966.13. So we are saying that if the yield increases by 40%, so that means we have a 40 base point, that is change in the price of the bond. We are saying that if the yield increases by 40%, so what happened? Then we now have percentage of change in price. Percentage of change in price. That is, we want to look at it, that what is the implication? What is the implication of the increase? What is the implication of the increase, and how will it affect our calculations and the share price that we have? So we're saying that change in the increase in price, percentage of change in price is equal to D divided by 1 plus rate. So our change in rate is simply 3.67 divided by 1 plus rate of 7%, then multiplied by 0.004, that is for year 4. So if you do it very well, you have what we call, you have 1.37%. So this means that the modified duration approach predicts that the bond price will fall by approximately 1.37% in response to the 40% increase in yield. In response to the 40% increase in yield. So, having said that, then the revised price, of course, we are supposed to look at the revised price. Having estimated that, we can say that the revised price will be 966.3, which we've gotten before, multiplied by the effect of the change, which is 1.3%, 1.37%. Then you have this. So the revised price is 952.89, which we can see that it is now lesser than the 9.66.13, which we had initially. So the revised actual will be what? Will be this. So now we are now changing it. Remember, we said that that there should be a change in the question. They said something like that. Okay, they said that using a mean deviation, that assuming that the yield will increase to 7.4%, that is, the yield is increasing from 7%, it is now 7.4%. And that's what we try to do here. We try to look at the effect of the increase from 7% to 7.4. And the effect of the increase was that our market yield has now reduced to 953 naira. So we can see that the observation here will be that the results are very close, and this could be expected when the change in yield is very small. So yeah, so we can see that this one is 953, and what we had before was, okay, this is less than 966.13. So we can see that the result is very close. And why? It is because the change is just 0.4%. Sorry, 0.04. That is, i.e., that is 4. So the difference is just a 4% increase. So which is very minute, and that's why you see that the range, the what's it called now? The difference between the answers, they are not so wide. Yeah. And one thing I also want you to note is that we also need to be careful that by the time we are doing our extrapolation in year 1, we see that we only considered the interest, which is 60, year 2 interest, year 3 interest. But by the time you get to year 4, you have to consider the principal as well. So in year 4, we have to consider the principal. So we can see that that's why we did use 60. And if you even go back to the one we did before, you will see that when we got to year 4 here, we also make use of, so this one should be 1060. This is 1060, not 60. So yeah, so you have to increase the capital also so that you can get this figure. So it is important we take note of that by the time we are solving a question under bond valuation. The value of the bond, the face value of the bond itself needs to be considered in the last year at which the bond is going to mature, at which the bond is expected to mature.